Welcome to our series on building strong financial future. Today is our week number 10, and today will be the concluding part of our discussion on universal life, permanent life insurance. So my approach today is to run us through the advantages of universal life and then to also talk about an illustration using an example. So what are the advantages? It's a lifelong coverage, that is a permanent life insurance. We all know that. It has a cash value component, that is, like I said last time, part of what you contribute every month goes to a fund that you pick with your advisor, and part of it goes to cost of insurance. So with time you build cash value. It has a flexible premium, that is, universal life comes with minimum and maximum premium. So it's flexible. So you decide how much you want to contribute. But of course, the more you move further away from minimum, the more money goes into your investment portion. Over a long time, you build cash value and you can request for a loan from the insurance company. Or you can take your policy to a bank or financial institution and say, look, I have so much in my cash value. Can you use my policy as a collateral and give me a loan? And also, it has a tax-deferred growth. So in your portfolio, whatever growth you have there, you don't get every year a T5 like every other person that have investment somewhere else. They're getting T5 maybe for the dividend growth in their investment and they're paying taxes on it. No, yours is deferred when it's in that policy. Of course, the death benefit will also increase because the cash value has also increased. So now let us take an example of a 30-year-old non-smoker, a male. The person decided to do universal life for a $250,000 face value. The minimum premium is $108 and the maximum is $739. So this person choose $150 a month premium. And this person also said, I want to stop paying premium at the age of 65, which is one of the flexibility of UL. And then, this person, after discussing with their financial advisor, doing the risk profile, they settled for a fund that can return more than 7% a year, but they settle for 7% for the purpose of the illustration. So when we look at the illustration, by the time this person is 65, the cash value component of their investment in this UL has come up to $190,000. When you look at what this person contributes every year, which is $1,800, they've contributed a total of $63,000. But then their cash value in their portfolio component is now $190,000. This person can borrow up to 90% of this $190,000. So at age 65, this person says, oh, I want to retire, but I want to pursue a business of my own. I can now access 90% of $190,000 as a loan to start a new business or to start something. That is the beauty of UL. The death benefit has risen to $331,000 at that age of 65. So those are the beauty of UL. Or the person can say, okay, I'm going to take that policy as a collateral to a bank and borrow money up to 90% of that $190,000. So you benefit from this policy while you're alive, not only when you're gone. Now, there's also called living benefit in UL. What is living benefit? That is, if this person suffers a very serious illness or critical illness, they can also withdraw money from the policy to take care of themselves. But of course, whatever you take out of the policy will be removed from the death benefit when the person passes away. So that is the beauty of UL. So we're going to continue next week with another topic. My name remains Adekunle Ajishibutu, CPA, CMA. And please comment, share. Thank you.